Good afternoon. Welcome to the TheoTrade afternoon video. I am Blake Young and today is April 16th, 2025. And today we're going to talk about crude, energy stocks, and utility stocks and the decorrelated correlation. And to do that, we're going to start with this crude oil inventory that came out today and walk through a couple of economic principles. And then we'll dig into the historic correlations and what we're seeing not happen in the current market. So to start with, we have crude oil inventories came out today, and you can see that we had a better than expected. We went from 0.4 million, or in other words, 400,000 barrel build expectation to 500,000 billion barrel build. That would tell us that we have 100,000 more in crude oil inventories, but that is not climbing as much as it should, considering that last month we added 2.6 million barrels. If we look at the history here, we went negative and we have not recovered off of that negative as far as the inventories or the storage. Now, if we go directly into the energy information page, it's going to take us into some key data, and this is going to show you oil production. Oil production rose by 2% in 2024. We have that report for the end of the year, and you can see overall the growth here. Permian Basin is the monster that is producing most of the oil in the United States and the largest component. But as we look down, you can see that U.S. crude oil production grew 270,000 barrels per day in 2024 to an average of 13.2 million barrels a day. So that's how much the U.S. is producing. It's not showing us the whole world. It's just talking about the U.S. production. If we scroll down, you can see that wind and solar is now taking 25% of the total combined share of generation of energy, which is up 7%. So this higher demand and the higher energy production, we're increasing the demand in energy production through crude in the United States, both the production and the demand, I should say, while we're also increasing the use of solar. So we're just simply using more electricity. We're using more power. We're using more natural gas. And you can see that in the daily electric power demand, that's up 5% from last year to this year. And so major increases as far as demand of energy. So the demand is high. Production is growing. Demand is high. We're producing more from other sources, but we're still using it up. So if we look at the short-term energy outlook, this is the one thing we're going to look at. If we have higher demand, at some point, we need to see that that is going to show in the increased price of crude. Right now, crude, this is where we're at here, is in the 60s. Price through 2025 is expected as far as the probability, the confidence interval, that by the end of 2025, we would either be as low as 40, but that's kind of the outer edge, or as high as 100. That gives us an opportunity to say, well, if your math is right, if we trust that the people at the energy department who are way above my pay grade as far as analytics and probabilities are accurate, they're predicting that you have a probability of $40 increase, which is 66% increase in value, versus a $20 decrease. So we have twice the dollar amount potentially in the value of oil per barrel. So double the potential to the upside than to the downside. Theoretically, right now, if you played only off their statistics, we would expect a 2-to-1 reward risk ratio by the end of 2025. That should set us up for some opportunities, and we're going to start with this component here as we're looking to define what we're seeing in crude, what we're going to see in energy stocks, and what we're going to see in utilities. Now, compared to crude, if you've been with me for any amount of time, you know I've used to say 68, 78, 68, 78. As this goes back years and years and years, you can see if we go back on crude prices, this level of 65 to 68, this whole level goes back 10 years. And when we bounce, we have a tendency to slow down sub 80, so 68, 78, that $10 swing. And when we break free, we generally go about $10 more when we go up to closer to 90. But we overshot that and broke down $10. The low of that block, that yellow block, dropped $10 and we're recovering. So my question is, if we're sitting here at $62 and the probability by 2025, by the big analysts over there at the energy department, say that we have a equal odds, but of twice the size move up than down, then really the opportunity is, can I find the bounce? Can I find the continuation? Can I find the climb to get us back into crude or into energy? And you can see this is a weekly candle, so it'd be nice if we cleared the high at 64. From the daily candle, if we go back there and look at the daily candle, this consolidation, it'd be nice if we can just break out of this consolidation. So 63 even, but 63.88 would kind of be my key level, because that would break out of this consolidation, and I'd expect it to go $10 again, which should push us back inside this block. If demand is remaining high, which it appears it is so far, this should be able to hold up. If we go into recession, that game is off. We do not chase crude. If we go into recession, demand could collapse very, very quickly. But right now, I'm looking at this as a consolidation after overshoot to the downside. A move above 63 should take us up to 68, should take us up to 72, and potentially, as we just saw, up to 100 by the end of the year. So there could be a big opportunity in crude. If we look down here at the bottom, I have the correlation study between crude and energy. And you can see, no surprise, that if crude is falling, energy companies are going to fall as well. It means they make less money, they have less margins, they're not as profitable. If they're climbing, if crude's climbing, we end up making more, and you can see the correlation's high. There's moments we decouple from there, but overall, a very high correlation. We're dealing with a correlation of about 94% correlated between crude and energy. So if I do think energy is going to break out, or I should say crude is going to break out, I'm going to start looking at energy stocks. Now, compare that to a historic correlation or inverse correlation that people used to rely on. They used to say that if crude or energy costs are high, then utilities suffer. That utilities, especially deregulated utilities, they don't make the money when energy costs are high. So if I put in something like XLU, utilities, and compare that to XLE, you would think that we'd have an inverse correlation. If the energy stocks are doing well because they're making more and more money because the cost of energy is more, then utilities should be going down. But you can see the correlation is broken. We'd expect to see this inversely correlated. Currently, at this very second in time, today, we are at a 68% positive correlation. They're moving up together. So what it's telling me is that we're not buying utilities based off whether they're making margin, whether they're making profits. We're buying utilities as defense and fixed income strategy, not as a counter to the cost of energy and how much margin those utility companies make. If I look at this for the longer time frame, here's 3 years, you can see, again, that decoupling has happened, and we just have not been able to maintain the inverse correlation that people used to rely on. Now we're up at 80% for the last 3 years. If you look at the last 10 weeks, that's what this correlation number is. The last 10 weeks, we have an 80% positive correlation. So energy and utilities are moving together and have been, arguably, since last 2024 October, and have that positive correlation. This tells me that I don't need to be afraid of being both bullish utilities and bullish into energy. So I am going to look for energy stocks, but I am also looking at this overshoot here, already confirming the breakout and pushing back to the moving average. We're above the moving average, which is a 20-day moving average. And if we're staying above that, I'm looking at being bullish in utilities. And if we look at the heat map, you can see the bullish sectors just today. We can see there's a lot of green in healthcare, there's a lot of green in real estate, there's a lot of green in energy, and there's some green in utilities. So I'm going to be looking for those anyway. Let's see if we can find an entry with some of these energy stocks if they're already breaking out. And going through the top 10 in the energy sector, really the only one that we have is EQT. EQT is the only one that's cleared that recent high. It doesn't mean there's not opportunities in the other charts. I'll show you one example here momentarily, but EQT has reversed and actually closing above that moving average. We do have earnings, so we need to be aware of that. But if EQT can maintain this, if they don't miss like they did last earnings, then we're probably looking for a retest of 55, and we're talking about an 8% climb just to retest the high. If oil prices continue to go higher, they have better than expected earnings, I'm expecting this entire pattern to duplicate, which means that we'd be going up to 65. So from 51 to 65, now we're talking about a $14 move, and we're approaching a 22% increase in price in something like EQT. But that's not where we have to play. We don't have to play just buying the stock and hoping that we do well with earnings. What we have is very high premium in these energy stocks. If we take a look at Oxy, for example, let's take a look at Oxy really quickly. Oxy, and we go to the trade tab. If we look at the month of May and look at the premium that they're going to pay at the money, the closest strike we're at right now, we were closer to 37.50. Let's use 37.50. What this is saying is that if I'm willing to buy Oxy at $37.50, $1.40 cheaper than where it's currently trading, they're willing to give me $1.40. And that's 4% at my assignment value, which reality means I'm taking a trade by selling a put and being willing to be assigned, that they're willing to give me 4% at a 4% lower price, and really I'm having a setup that's giving me an 8% safety net if I sell the put right now. Price would have to fall 8.2% before I take a loss if I hold this and get assigned. So if I don't think Oxy is going to drop 10%, if what we saw from the energy department says we have twice the distance on the upside as we did the downside, I would expect Oxy and ExxonMobil and Chevron and Halliburton and Schlumberger and all those companies to have a better shot at doubling their returns versus their risk. And so as we're looking at that, that's giving me an 8% safety net. Now, I did not look at ExxonMobil's, before I leave here, Oxy. Just so you know, if we do get assigned, we're also getting a 2.47% yield. So if we look at ExxonMobil, same kind of story. It's only 2.38%, but we're closest to the 105, so that's only a 4% safety net, not as good as Oxy. If we look at something like Schlumberger is about, it's closest to the 35, but it's only a 5% window, 6% minus the cost to get us back down to that price. So Oxy does give us this biggest safety net for the best return as far as assignment and shorting that stock. I like it. I like the setup. Now, if that's the case, there's some trade opportunities in energy without the confirmation. Going over to utilities. I'm not as worried about whether they're up or down today. I'm just looking to see, can I get a reasonable return for my willingness to buy in? And if I do buy into these stocks, that then I have a good dividend after I'm assigned the short put. So if we look at some of my favorites like Nextera, or if we looked at Dominion or SRE, I'll show you what I'm looking for. Now, it's not the same kind of, Oxy is just by far bigger than any of the others in energy, and so that does show us there's more risk, but that gives us an 8% safety net, and the expectation is very positive there. That's a side note to the energy department versus what we're going to look at here in utilities. Utilities we're treating as a substitution to fixed income. So if I look at NEE, what we'll see is that the short put at 65, which is $1.70 lower than we're at, is a 3%. 3% dividend, or sorry, 3% short put premium if we're willing to buy it at 65, $1.70 below where we're at. So that means that this $1.90 is about 3%, 3.06. That means $1.70 is about 2.7. That's giving us a 5.75% safety net. Even if it drops down and assigns it to us at 65, our cost basis is at 63.30. And so 63.30 from the current price of 66, we're talking about, again, a 5% drop. It'd have to drop 5% before we're in trouble, and then we're going to get a 3.4% dividend yield on this one as well. Looking at the chart, the bounce down today is a little bit of a concern. I'd like to see it stabilize, especially ahead of earnings. And if it stabilizes anywhere above 66, I'll consider setting up that short put. But if we look at other stocks inside of utilities like SRE, SRE is higher, and we look at SRE, they're willing to pay us a same or similar 3% for my willingness to buy it at 70 when it's at 70, 66. So that's giving us a 4.5% safety net on this bounce. Now, it has not cleared the high. I would love it if it did clear that high first, but it's still giving us a 5% safety net, which means it could drop $3.50 before we even get to the point where we have risk $1 if we hold it after being assigned. So there are opportunities even while we're waiting for these to break out. I do believe there's going to be some clean opportunities in buying utilities, in buying bonds, and even buying into individual energy stocks today and throughout this week. And those would be longer term plays to be able to benefit from the dividends. And then after you are assigned, you can actually sell calls against them to continually reduce your cost basis or increase your income while you are waiting to get your dividend payments on a longer term position. Those are the setups I'm seeing right now. that's what we're talking about today. So thanks for watching. Join me again next week. Join me again tomorrow as we talk about some long-term deep currents that we're seeing in the main room. And otherwise, have a fantastic day.